Mr. Jesus, in other words, Donald Trump. That I obviously refer to the truth story from him here.
I've never seen this stupid stage before, right? I've never seen it. But if I walk left, there's a stair.
Happy Sunday, everyone, and welcome to the Macro Sunday podcast. My name is Andreas Steno. I'm the founder and CEO of Steno Research. And this week, we admittedly have to look a bit into why we've been wrong-footed. And no one's better at explaining why we're doing things wrong than you, Emil Moller.
Thanks for the introduction. Very kind. Yeah.
Our head of research. Always good to have someone to blame if something goes wrong, right? I'm just kidding, obviously. But I guess this week, in this independent macro show with actionable ideas, it's a good idea to play the disclaimer. So, given last week's performance in markets, it may be worthwhile listening to Gennaro Gattuso.
Sometimes may be good, sometimes may be shit.
Obviously referring to the portfolio here. I mean, it could have been worse. I remember exactly a week ago, Emil, you and I had the champagne corks flying in the studio because we had 100% hit ratio 8 weeks in a row. And obviously, as soon as you start saying shit like that,
you get absolutely clammed.
So
here we are.
it isn't that bad. No. Obviously, we have professional risk management around this, but it hasn't been the best of weeks.
No. Fair to say.
It hasn't been the best of weeks for Kevin McCarthy either.
Definitely not.
He's basically been ousted as the Speaker of the House, the official title. And before we get to the discussion on what that means for the US economy and whether we can get curbs to spending as a consequence of this, I'd like to play the soundbite of the week. And it's from a favorite of ours, at least from an entertainment perspective. Mr. Jesus, in other words, Donald Trump. That I obviously refer to the truth story from him here. Talking about how Joe Biden is doing.
Oh, dear.
Has become crooked Joe Biden's top surrogate, I think, because he doesn't think Biden is going to make it. That's why he's doing it. He doesn't think he's going to make it, and it won't be him so easy. He's going to have a big fight. However, because there will be a lot of Democrats competing, it's going to be very interesting. But let's see. Look, some people say Biden's going to make it. Does anybody think he's going to make it to the starting gate? I mean, the guy can't find his way off of a stage. Look, here's a stage. Here's a stage. I've never seen this stupid stage before. Right? I've never seen it. But if I walk left, there's a stair. And if I walk right, there's a stair. And this guy gets up. Where am I?
I've even seen
Where the hell am I?
like early rumors of discussions of Trump being the new Speaker of the House. I don't know whether it's actually practically possible. It probably is, but
I think it's a bit contagious, but is he wrong in this clip?
Not necessarily. Not necessarily. So,
you know?
But Emil, on a serious note, in relation to US politics, McCarthy is no more, at least in the role as a speaker. We're obviously stuck in some sort of stalemate between the Democrats and the Republicans relating to the future ahead for the public deficit of the US federal government. And we're stuck in a situation where the deficit is running wild, essentially.
Absolutely.
So what are the prospects from here from a political perspective, and how will it impact fiscal policy?
Well, that's
easy question, right?
That's a big question, right? First of all, I'm still starting to get my head around what McCarthy was thinking here. I mean, what was the end game? I can't really see it, to be honest. And well, now he's gone. But I think what we should take, the main takeaway here should be that the shutdown is just postponed. I think that's absolutely crystal clear. That's the only thing I'm really fundamentally convinced about. And if that is true, and we don't see any deal making for the remainder of the year, then back of the napkin calculation, 6-8 weeks of a shutdown equals to around 1% of GDP, basically.
That's not pretty.
No, it's not
No.
pretty.
Especially not given the critical momentum that we see globally heading into this.
Exactly. And that's so perhaps that will change the the negotiations outlook, and perhaps that will make the Democrats concede to postpone spending cuts or something. That could be on the table, but I think for now it's just further fire, further gasoline to the bonfire here.
Oh, don't mention gasoline. I get my nerves.
Yeah, oh dear. Yeah.
I have to admit that should we get a 6 to 8 week lockdown, or shutdown, sorry. Don't remind me of lockdowns either.
It's former podcast. Yeah.
Then, I mean, given everything that's been ongoing in markets over the past couple of months, the U.S. superiority theme firmly in the driver's seat of everything. Strong dollar. The U.S. doing better due to no energy imports on a net basis, and all of that. Could the dollar be challenged here if we end up in a complete soap opera politically in the U.S.?
Thing is, with rates at these levels, I mean, capital is just storming back into the U.S. to attract those U.S. dollar yields, right? You want that safety, especially in a global cool down of the economy, right? So no, I just think the others will suffer along. That's basically my takeaway. But perhaps it will be the start of that gap of U.S. exceptionalism versus the rest of the world starting to narrow. So that's something to look at. And if my prediction of a recession in Q1 essentially materializes, actually after this week, I'm starting to question whether it will perhaps start a tad further, a tad sooner. I mean,
or maybe it's already here.
Ooh. Exactly. Well, that will, mark the pivot in the US dollar strength, no doubt, because essentially Powell, he will come in and cut the rates down and everything,
Yeah.
That's why I'm sort of on the sideline looking at those juicy nominal yields, just waiting to step in. But still, we haven't caught that knife yet, luckily.
No.
So yeah.
And in relation to that recession discussion, obviously, it's the National Bureau of Economic Research that ultimately defines whether we are in a recession or not. But I can guarantee a few things in relation to that. The first is that the NBER will not conclude that we're in a recession until a long time after we've actually been in one.
They will tell you you're dirty while you're in the mud.
Exactly. And the second thing is that only real money players like huge pension funds will start trading the recession narrative once it's confirmed.
Yeah.
So we obviously need to consider whether that recession narrative is back on the table. And therefore, I'd like to get your opinion on the current developments in the yield curve, because obviously the yield curve is typically seen as some sort of harbinger for like future developments in growth. And we still have an inverted curve. We're far from a reinversion still, even though we've seen between friends more than 50 basis points of steepening between 2s and 10s. And it still seems to me like there's a mounting pressure on the long end here, despite all of these early warnings of recession, shutdown, and all of that. What do you make of the yield curve here?
So, well, we timed the entry pretty well. Let's start with putting that out.
On the steepener.
On the steepener, and I think we are approaching the top of the 10-year. I think that's coming in, even though that the pressure right now seems to be really strong. I think it will revert soon enough. The question I'm sort of pondering here is, usually we see a re-steepening of the yield curve and then a recession, right?
Yes.
Yeah. It uninverts, and then it goes back into a steep territory, and then pain unfolds.
Yeah.
And I think we on that last sort of step before that kicks in, and that makes me question whether it's you know whether it is now that you should start to be long bonds and take on that convexity. I think that's really the next place in line. The only thing here that sort of had me going, or had us really, standing on the sideline, was the pressure from energy. And this week's report was rather shocking, and perhaps a bellwether on the overall state of U.S. consumers and the economic activity in the U.S., which seems to be sliding. So,
Yeah.
yeah,
We'll get back to the details from
Yeah.
this weekly report from the energy authorities in the US, or the energy agency, rather.
Yeah.
But I'd like to go through 5 drivers of this yield curve,
Yeah.
one by one, because they're kind of obvious to most, but it's still very relevant to sort of dissect the underlying numbers on each of these 5 parameters.
Yeah.
And first of all, we've been very vocal that the cocktail of rising energy prices and the positioning already leaning long duration was sort of a toxic cocktail for
Yeah.
markets. And we obviously had that exactly right until energy prices started receding again. But when we look at positioning right now, it's quite interesting that we see a change of scenery, given that hedge funds are now longer duration risk than real money players.
Yeah.
And that's kind of vice versa of what we've seen earlier this year, Emil.
Yeah.
So what do you think positioning is an issue for the long bond bets still?
Yeah, it's a good question. I think it is, and ideally, you wouldn't want this set up before entry, right?
No.
But sometimes the smart money, they figure it out first. Question for you: if you could buy the 10-year, put it in the drawer, and pick it up in Q2, Q3, 2024, without leverage and not thinking of drawdowns, would you take it?
Oh, the reason why I'm hesitant here is that I've answered yes to that question before.
Okay, yeah, all right, fair enough.
And but sure, I mean, it's pretty simple bond math here that 100 basis points downside in yield terms provides you with a so much better return than 100 basis points in the other direction.
Exactly.
And given that, you obviously need to have a pretty firm modal outcome for higher yields to be against this trade. And I'm not sure that I have that on a 6-9 month horizon.
Fair.
Am I tempted to wait? Yes. Since we haven't pulled the trigger, that's kind of the conclusion as well, right?
Yeah, sure.
The reason is that, I mean, on positioning, real money players are not as heavily involved in the long duration bet relative to benchmarks as they were a couple of months ago. They've obviously been bleeding like crazy over the past couple of months here. And that is obviously why we see a squaring of positioning. But I think the air is sort of starting to clear, if that's a saying, in relation to a couple of the important drivers of the yield curve. One thing is that, I mean, Emil, you obviously track Asian markets as well very thoroughly. One thing is that we've seen some kind of intervention in yen markets. It's tricky to actually ultimately conclude that it is intervention that we've seen from Bank of Japan, but something happened when we crossed the 150 level. And it seems like the appetite for very strong one-sided FX intervention is not there from the Asian central banks. That they're not throwing dollar assets at the market at a rapid pace. They could have done that, which would have been a complete doom loop.
They have a capacity for it, that's for sure. Yeah.
But it rather seems like they're selling gold than U.S. Treasuries here, if anything, right?
Yeah.
That would be my conclusion, at least from watching price action in recent days.
What it looks like, and I sort of forewarned this in a piece in the spring, right? gold has some fundamental headwinds coming into the next couple of months. I think that's playing out now.
Yeah.
So yeah, when you lose on gasoline, you take one on the gold, I
Yeah.
suppose. But yeah, I think that's absolutely spot on.
Yeah, and then I mean, given that Asian central banks are not like firing on all cylinders on that doom loop FX intervention with a one-sided strategy where they sell dollar assets to buy local currency, thereby pushing up yields in the US Treasury market, once again allowing a mounting pressure on the local currency versus the dollar from a yield perspective, and so on and so forth. If they abandon that doom loop, they've been in the doom loop, but in a mild doom loop, I'd say.
Yeah.
Then I actually consider it pretty good news for the US Treasury market. The best thing that could happen to the US Treasury market right now would be that the Chinese, the Bank of Japan, they allowed the dollar to strengthen versus their local currencies, in my view. It's debatable, but that I think that would be quite a decent development. And if we agree that they're not going to fight towards the end of the year or maybe into early next year to defend these local currencies, if we agree that positioning is not as bad as it was a couple of months ago, if we agree that the energy story probably doesn't look as bad as it did a week ago,
at least,
then we only have that complete mess of a public deficit in the US to really be scared about from an issuance perspective, right? Issuance in 10 and 30 year space is up 23-25% thereabout year to date relative to last year. Quite a lot. So that's an issue, obviously. But I mean, back to that McCarthy discussion, right? If they actually manage to curb spending here, it's a strong buy.
But the thing is, even if they don't manage to agree on anything, spending will be cut automatically.
Yeah, sure. Yeah.
That's it's 1% in spending are programmed after from next year if they don't achieve any final deal. So I think you're absolutely right, and that's why I'm sort of hinting that I don't think bonds is a bad place to be. Famous last words. Soon enough, I think we would start to see that in the yields, and perhaps we should enter it as well. But for now, I'm comfortable on the sideline, even though I'm a bit anxious to step in, because I think once this really gets going, I think it will be really profitable.
Yes.
So
But back to our current position of a curve steepener, right?
Yeah.
What I like about that trade, and the reason why I'd perfectly accept to enter it from today's levels as well,
me too,
is that you can be right for the wrong reasons here.
Yeah.
Exactly. And given how wrong I am often, I tend to like such a setup, right? My point here is, should we get a shutdown, should that be some kind of a trigger for a recession? Should that ultimately lead the Fed towards a cutting cycle? All good.
It's fine.
All good. It's the front end that does the business here. Should we get that reacceleration continuing in manufacturing? We haven't even touched upon the very, very strong ISM manufacturing report relative to consensus, at least. Should we get that weird cyclical uptick right now? I wouldn't completely rule it out.
No.
It seems odd, but I wouldn't completely rule it out. Our models are still positive on ISM manufacturing. Typically something that would put upwards pressure on the long end, right? Then you can be right for the wrong reasons as well. So I struggle to see the scenario that allows the Federal Reserve to invert the curve further once again. We would need to see a massive refueling of inflation alongside rate hikes to get that scenario. And I struggle to see why that's more than, say, a 10-20% probability scenario.
That gun is running out of bullets, right? You don't really see much in the pipeline that could really propel that. So I agree.
So it basically means that it leaves the steepener with a solid risk reward.
I think it's the best risk reward from second half of this year.
And
I'm really glad we entered it at the timing we did.
Yeah.
No, I don't see any scenario where the curve starts to invert even more. So it's a simple risk reward.
At least not
materially.
over a tradable horizon, right?
No.
Famous last
words.
Emil, we didn't really touch upon the details of the energy market because I wanted to elaborate on that.
Yeah.
We've obviously had a challenging week due to our, say, long energy bias. We actually took the profit on a very, very good timing on our long energy call.
Yeah.
We moved to nat gas, the front month Henry Hub. Been a perfect switch from oil to nat gas.
Yeah.
But, and here's the flip side,
Yeah.
we had a position in refiners as well.
Yeah.
And gasoline cracks, they're basically through the floor.
Yeah.
Diesel cracks are still doing well. So what do you make of this mixture of trends and signals across the energy market right now? Anything that is really important to point out here?
I think the energy markets at the center stage of the geopolitical tension that we're witnessing. I think when it comes to diesel and we look at the local European market, I think there's a reason to be a bit worried coming into the winter on that score. But I do think that the message of particularly this report that now demand is starting to tilter, that would sink in among the OPEC gang there. And well, I basically put it out last week that I think the Saudis, they will pivot on the production policy sooner than many will probably anticipate. So I'm starting to lean towards that on a global scale. We probably have seen the top of the of the the push from energy on a global front. But I still think locally you will find, there will be issues. There will be bodies.
Obviously, nat gas is a much more regionalized market
Yeah.
than oil.
Yeah.
Why we can have local explosions in nat gas without
Exactly.
global explosions,
Yeah.
at least temporarily. And the point here is, Emil, that the weekly report on everything from inventories to the implied demand from inventories and production numbers from refiners. The DOE weekly inventory data released by the energy agency in the US. I had one word when I looked at the numbers, and it was ouch. And I immediately looked at seasonal patterns to try to find an explanation. We're obviously on the edge of the maintenance season for refiners, leading to lower production. The issue here was not the production number. It was the inventory number that came with it. So production down and inventory up in retail gasoline. That's an odd one in September because there are no reasons for such a landslide. So when I ran this through the so-called X13 ARIMA seats model. It is used by the BLS to seasonally adjust US time series. There are lots of issues with that over the course of the pandemic, but we'll leave that for another podcast. I'm not even sure I dare listening to such a podcast myself. It will be boring.
But if you want to lose your mind next week.
In any case, I ran the numbers on the implied gasoline demand. So basically, say the implied demand from production versus inventories. And it's bad. It's really, really, really bad. Down 12, 13%. No real explanation. We've had, we allowed the whole office to spend the entire day on watching those numbers. Could we find something weird? And we could not.
Not until now, no. I would still see if we can localize something tomorrow, but from as of talking, we haven't localized anything, right?
No.
But here's a question, right? Are there anybody out there who are stronger than the US consumers, looking from a global perspective? And if they can't cope with
the energy prices,
what does that tell you? And if I may elaborate a bit on this, right? So we got the GDP revision number some time ago, and it sort of made me question. Okay, maybe it was.
We're starting to see big revisions.
Yeah. And I thought, okay, perhaps the economy is slowing down faster than I thought, and perhaps that recession call is could actually materialize in this quarter. Then we got the ISM manufacturing, and it we pretty much hit it spot on, and I dare not believe it when I saw it. And I thought, all right, that's interesting. And then we got the ISM services, which was a tad low, but especially the employment component started to loosen a bit up. And now this with the EIA, and we have the credit card data, which also looks pretty atrocious. So I think the overall takeaway here is that we are on the slide now. The question is merely the rate of change, I think.
Yeah.
So
I agree with you. This has to be
excess savings. I forgot to mention there.
Yeah, they're
well.
close to being depleted at least. But I agree, it has to be some sort of signal that the U.S. consumer is about to cave in.
Yeah.
And especially if you look at, say, the bottom 25% percentile, they obviously have depleted excess savings already. It doesn't really matter for the gasoline demand whether Bill Gates have excess savings or not. He's probably driving an EV anyway.
Solar panels.
Yeah, exactly. So, point taken, Emil. In terms of the oil market, I mean, everyone and their mother concluded that the deficit for Q4 was there or is there.
Yeah.
I still think that's the case. But we're closer to balancing supply and demand here. If we look at the numbers from this weekly report from the Energy Agency, we can calculate backwards basically from the drop in gasoline demand to the amount of barrels needed per day, and a slide of say 12-13% in the fuel usage in transportation globally is massive.
Shocking.
It's massive. It's almost pandemic. I'd say. And 12 to 13% drop, a 12 to 13% drop in the gasoline usage is the equivalent of a bit more than a million barrels of oil daily. A lot. And this is just 1 week of developments, right? Or from one report to the other. If this is actually a trend, you will obviously see an even weaker report next time, I'd say.
Absolutely.
So this is one to watch. We're on the sidelines. Should we get to lower levels in the oil, we will reconsider entering. But this was a Mike Tyson-like blow to our thesis.
It was.
I have to admit that.
But on the other hand, I believe when oil was above $95 a barrel and that territory where we switched basically, I did say that
sure.
The big danger here is whether demand can actually cope with these prices, and that has played out a bit faster than I thought.
And the big issue was that we entered a refiner's trade on the back of that, trying to catch some late alpha in a spread versus transportation. So it's been a good idea to short transportation. By the way, the consumption patterns showcased in this Energy Agency report with 12 to 13% declines in the gasoline demand is a green light to short the fuck out of that transportation ETF still. But that's a whole different discussion.
Definitely.
So maybe we should re-enter that trade. Now I'm just live trading.
It has already taken a lot of punishment, to be fair. But but we can say on an overall spectrum. I mean, do we like being long equities?
No.
I've pretty much put it out there.
I mean, seconds after the oil market started puking on the back of this report, the automatic response due to the spillovers to interest rates was just to buy consumer discretionary stocks. And I'm like, if you're not able to buy gasoline, why the hell would you buy a Tesla? Maybe because of the price of gasoline. Okay, that was a bad example. I mean, discretionary spending is probably the last thing you should buy if spending is going down.
Well, Bill Gates using his gasoline savings. Don't know.
I mean, I don't always get markets. Sorry.
No.
So, Emil, the short trade update from our side. We're still basically loaded up in that steepener. We keep that on our books. It's a strong risk reward trade. We would trade it at today's prices.
And we're in the money.
Firmly. And then I guess the big question here from an allocation perspective is how bullish to be on the dollar from here.
Yeah.
And I updated our quantitative Sharpe ratio optimized asset allocation model. We input liquidity, we input PMIs, we input inflation in the model. It leaves us with the so-called Goldilocks without QE regime right now.
Yeah.
It's my own invention, that name. Yeah. But without QE here means that liquidity is dwindling pretty fast. So the model tells you to buy dollar yen up here.
Yeah.
The model tells you to buy dollar peso up here after a pretty decent rally.
Yeah.
It tells you to buy silver and gold. It is basically, I mean, it's almost the 1930s portfolio, this or whatever, right?
Yeah.
Long dollar and long precious.
Yeah.
That's what it's telling you. Not necessarily a usual cocktail, but
no,
I mean, I just let the numbers talk here.
Yeah.
That's quite interesting.
That is interesting. But I do think that the flaw with, firmly relying on quantitative backtested model when you are in a weird regime, it will wrong foot you, because it hasn't seen this pattern before. It's just computed into it, So, but yeah, it is interesting. It is interesting, and to be fair, the US dollar is just hammering, everyone and their mother for weeks now, which sort of leaves me thinking that if this energy relief here gets some momentum, we might see, rates just dropping a little bit, and it might just push some tailwind into the equities, and then everyone is caught off guard before the clam down. It's sort of a thing I'm thinking could materialize. But to be honest here, I think we are in treacherous territory, to be completely honest about it.
I mean, from a risk premium perspective, buying dollar equities here and now is chasing pennies ahead of a steamroller. Right? It is.
Yeah.
I mean, you get the same expected earnings yield as a 3-month T-bill. Is it really worth chasing those equities higher here?
Would you refute that markets could be that daft?
No, sure.
That's
sure.
Sort of the thing.
Yeah.
I agree completely. I mean, I can't find any metric or any argument to really be long beta here, and perhaps that's the reason to be it.
It's not the worst argument I've heard.
That's saying something.
Indeed. But it's not the best.
No. Taken.
Yeah. So we'll see you again next week. I'm still tempted to say that the dollar is a strong place to hide in this situation.
Yeah.
I'm still tempted to say that the curve steepener works. We have it on our books with a load of backing, nominally speaking, and then I'm still tempted to look for relative value trades that can sort of cope with natural gas prices on the rise, because I think natural gas is still a decent risk reward. We're also long the Henry upfront month, so I think we will leave it at that, Emil. If you enjoyed listening to this podcast, and if you want all of the details behind how we seasonally adjusted the gasoline demand and how we will seasonally adjust the gasoline demand going forward, because our clients received this report basically, if not minutes, but then an hour or two after the actual report release. And I think it was pretty valuable for them to get that report, to get out of that trade while the train was still at the platform, so to speak.
Then you were caught off guard.
Then go to stenoresearch.com. Emil and I and our team will elaborate on cross-asset developments. We run this as if it was a global macro hedge fund, basically, and then we write about it. If you like such research, go visit stenoresearch.com and use macro30 to get 30% off your subscription price as a unique offer for people listening to the Macro Sunday. Emil Moller, great to see you again.
Likewise.
And I hope that we can have better news with us next week.
Can scarcely get any worse.
No. Remember, as a broad disclaimer, that Mr. Gennaro Gattuso is our compliance officer here at the company. So our trade ideas might be...
Sometimes maybe good, sometimes maybe shit.
Thank you very much for listening or watching the Macro Sunday. I'll see you again next Sunday.